I think we're live. Hold up. You between my arms. Okay, so I'm gonna. What just happened? Okay. So TPR. Get more on the data. Oh wait, there it is. Okay. So where do we end up tomorrow? And tomorrow we were at total net sales, understanding the total net sales of the company. So we're gonna look at the. What is this? Nope, don't care about this. It's a debt and stuff. I need the expenses. Feel like causing trouble up in hotel. Hello. Yeah, I heard. Sam was telling me about that earlier. Current trends and outlook. Okay, hold up. So it says. So right now I'm studying. Oh, that's funny. That's funny. So right now I'm studying a company called TPR. Because I'm not doing it for the views. I'm doing it to stream so I can look back on these streams to see what my mindset was when I was studying this company. But if anyone wants to join it, I mean, they can always can. I mean, it's not for the views. So I'm studying a company called TPR, Tapestry. Their three main sources of revenue are these three companies. Their primary company is called Coach, which makes handbags. It's a semi-luxury brand. Their handbags range from like $350 to like $600, from what I was looking at yesterday. And they have two other brands, which they're called Kate Spade and Stuart Weitzman. Stuart Weitzman they acquired in 2018. Kate Spade was 2015. Wait, I'm going to do 1971, 2015, 2018. They're moving primarily online. Okay, so let's see how they're doing this. Give me 1 second. I'm gonna. Okay, we're back. It's 310. Alibaba is at 103. I do want to add to my thing, but I don't have cash. Oh well. What can you do, right? What can you do? Okay, so back to studying TPR. So Kate's paid. Look at their expenses. Yeah, I'm gonna read this first. Hold up. Driving global consumer growth, macroeconomic conditions, foreign currency fluctuations, geopolitical events, spending on discretionary items. So the thing is that American exporters make more, are usually not benefited by a strong U.S. dollar, which typically occurs during our U.S. recession. So we can expect their international sales to go down, international sales revenue to go down in the near future purely because of macroeconomic conditions. Okay, so spending on discretionary items within consistent patterns. COVID-19, we continue the latest movement and purposes for our business and operating results, including assumptions and regarding duration and global macroeconomic impacts of the pandemic. However, the full extent of the COVID-19. Okay. So China was affected because of COVID outbreaks last year. Furthermore, fiscal tariffs. Yep. Okay. But no. Furthermore, current volatility potential. Okay. Worsening macroeconomic environment since fiscal 2019. The U.S. and China have both imposed tariffs, importation of certain products into their respective country, with limited progress in negotiations to reduce or remove tariffs. Additional companies historically benefited from duty-free imports on certain products from certain countries pursuant to U.S. generalized system of preferences. Okay, the GSP program expired in the third quarter of fiscal 2021, resulting in additional duties that have negatively impacting gross profit. Okay. Yeah, the 15% minimum tax and the 1% excise tax. Okay, cool. So this is what we were looking at yesterday. So SG&A expenses total of are they gonna show more detailed? Yep, there it is. Gross profit. Okay, there it is. This is what I'm looking for right now. Okay. So expenses. What the heck? Wait, what the heck? What is this? Why is this in a different font? What? Wait, no, hold up. Oh, there it is. So we're gonna look at SG&A expenses for Coach, Kate Spade, and Stuart Weitzman. SG&A expenses, SG&A. So we're gonna look at Coach, Kate Spade, Stuart Weitzman, corporate. Okay, cool. So for 2020, we get total. I'm gonna write total right here. Okay, cool. So this is 2021, 2022 is right here. 2022, we get 2079. What is this about? 2079. Kate Spade, we get, hold up. Kate Spade, we have 748.7 and 178.2. Corporate, we have 430.7. So we have some of 343.6. Whoa. 9.2. 2073. What the hell happened here? Okay, that's better. So I'm gonna put this as total revenue. Where is the total in sales? So this is going to be as percentage. For 2021, we're looking at wait, what's this? What other expenses did it show? Oh, so income. Okay, so that's just income. Let's do income as well. Operating income. Coach, Kate Spade, Stewart, Wietz, and corporate. Total. So that's gonna be total operating income. Looking at 1480.6, 163.3, 5.4, hold up, 5.4, then negative 430.7. Sum comes out to equals this over total net sales. So their operating margin is 18.2%. Okay, that's pretty good stuff. Gonna change this to currency. Sweet. That's cool. Okay, not bad. I don't care much about this because this is like a 1 year, so this is going to be adjusted. So 2021, we're looking at wait, what? Wait, I just messed this up. This is not even right. No, it is right. Oh my gosh, this is right. So their total of SG&A expenses. Yep, total SG&A expenses. So Coach is looking at 183.6. $183.6.9. Sorry, 183.6.9. 659.9. 173. Nope, that's not right. It's, did it not provide 2020? Wait, they did provide gross profit, SG&A expenses. Okay, so they only provided 2021 and 2022, so we're gonna have to look 1 year back. I'm gonna look at that in a second. But I do want operating income for 2021. See how that differentiates from 132. No, 132.1, 108.5, 8.6, and 444. Sum comes out to equals over 16.8. Why was this primarily affected worse than last year from current year? Even though we have more of these acceleration program charges. Okay. Net income loss. Okay, so they made $3.17 per share. Okay, that's not what we're caring about that much, but they're Yeah, we only care about operating income. Net income doesn't really matter to us that much anyway. So we're going to look at cash flows. Okay, what is this? Transparency, currency fluctuations. Okay. wow. I mean, that was not surprising, but interesting. Uh, Coach net sales. Okay, so they increased 15.7% year over year. Wait, what? Okay, so they increased 15.7% year over year to 4.92 billion, or fiscal year 22 expected to impact, excluding the impact of foreign currency. Following discussion is presented excluding favorable impact of 53rd week to fiscal 2021. Net sales 67 million. Attributed to net sales, net increase of 656. Okay, so they're purely retail driven. Net increase attributed net increase of 50, so that's good. High e-commerce in North America and global stores, that is a good thing. And a decrease in Greater China. So I'm gonna see what percent of China is related, is like their usual sales, so that can give us a better idea of how opening of China is gonna affect them. So 101.5 increase in wholesale. Kate Spade increased by 20% almost. Net sales. Okay, so I want to see year-over-year change for this stuff. Okay. Okay, I want to. How would I show this? So I did show year-over-year sales over here change. I want to see a year-over-year change. But, I mean, we can see a year-over-year change in revenue right here, but some of these are growing faster in their percentage-wise relative to the other company, and I don't want that to be. Okay, let's just read. 20% net sales. So primarily because of higher e-commerce. Gross profit. So 72%, 74%. That's an insane gross profit. Kate Spade has a gross profit of 63, which is also very good. Stuart Weitzman has a little less, but this went down. This stayed the same. This went down a bit. This went down almost the same amount. Okay, increased. Decreased 180 basis points to 12. Okay, compared to excluding items affected by reduction of expenses. Coach gross profit increases 13.1%. Excluding items affecting comparable. Okay. So this is a good thing because they're primarily growing because of higher e-commerce activity. So higher amount of freight costs, so supply issues. Unfavorable geography and product mix were more than offset by reduced promotional activity, stronger than anticipated sell-throughs. So okay, that's a pretty good thing in the eyes of an investor, because that shows a company's growing naturally. How much did they sell like marketing? Hold up. What is happening right now? Hold on, this is where we are. This is the current one, right? Okay. Cool. SG&A. So I want to see what. So this is a reduction. This is a reduction, and this is a reduction, which is all great because that means they're being more efficient in their SG&A. Okay, it's comparable to its percentage of net sales, decreased, excluding effect. Okay, SG&A expenses are percentage of sales, decreased by 42.1% fiscal year. This increase SG&A expenses is primarily due to higher market spend. Okay, that's fine because you're growing as well, so that's offset. Okay, that's fine. Operating income. 0.1 compare excluding items affecting comparability coach. Okay, so what we just read. So I want to look at the cash from operations. So cash from operations is one of the most important things we're going to look at. So cash from ops. So this is going to come out to, and we don't have 2021, so that sucks. What the hell? Yep, there it is. Ah, dang it. There it is. So we have less cash from last year. Okay, let's see why they decreased, which is not good. Again, what happened? Where is that at? There it is. So 1323.7 and 853.2. That is weird because their net income was much lower. It was almost like $300 million lower 2021 compared to 2022, but their cash from operations was down $500 million. Operating assets and liabilities partially offset by losses on extinguishment of debt. The impact of non-cash charges of 15. Okay, and higher net income. That still doesn't show. Okay, I want to see what happened here. Inventories were use of cash of 311 million fiscal year 22 compared to source of cash of 32 million. Accounts payable were a source of cash of 86.7. The other assets were use of cash of 28.2 million for fiscal year. So inventories were use of cash, primarily driven by high receipts, increase in transit levels due to longer lead times and increased inbound freight costs compared to the prior year. Okay, I want to see their balance sheet and see how that reflects. There it is. So their cash and cash equivalents were down a good amount. Short-term investments were up. So their total assets were down from last year, almost by $1.1 billion. So this was up. This was down. It's the biggest drop. Inventory is 200 million difference, 250 million difference, 40 million difference. This is 200 increase. Almost 8 million. Not much. not much. Okay, this is operating lease of use rights. This is PPE was down. So their debts increased, the things they have to pay in the current year. Liabilities were same. Current portion of operating lease liabilities. Okay, current debt. They increased their debt. Okay. Long-term debts increased by $100 million this date. Okay. And this went down, which is somewhat good. Wait, what is this? Operating lease. I don't want to see operating. Okay. Property and equipment, operating lease. Okay, are related to impairment, whether company uses its estimate of future cash flows, extend future undiscounted net cash flow between the carrying value of the fair value and its fair value. Okay, company recorded $4 million and $60.9 million impairment charges. Okay. These leases may also include rent escalation clauses or lease incentives in the form of construction allowance and rent reduction. And oh yes. Okay, so their assets. I saw a lot of the stores closed. That symbolizes that their operating lease agreements went down. That's why their assets, what they're saying, went down as well. So balance sheet. Effect on equity. Okay, I want to see the effect on equity. This went down. So there are an accumulated deficit. Okay. Total liabilities. So that's almost $200 million. That's I mean, yeah, that makes sense why it went down, but why did this go down almost 100 million? Oh, I mean, the 100 million came from here. Oh, 1 billion, sorry, not 100 million. So their deficit went up. Why did their deficit went up? Retained earnings. I want to see retained earnings. $2019, 2020. I want to see. Okay, so their net income was up. So So they primarily went into deficit because of dividends and repurchase of common stock. So they used their cash for, how much did they buy? They bought back $1.6 billion worth of capital of shares, and dividends were, so that would be 1.86 billion. So what's the difference between their, so if we were to add that basically to our assets, because 1.860, if we add that technically to our assets, then we get a real comparison of what exactly happened. 1.1680 plus 1860. What was it? So it was 1600. So it's 1860. So 1860. If we add that to our, where'd it go? What the heck? Okay, so if we add that to our assets, that comes out to 7265. Our total assets grew. So the thing is that they used their cash. So if we do 2007 minus 1860, it's 147. So they generated And if we add that, so if we add another $800 plus 800, so I mean these numbers make sense. Their primarily cash was down because of their repurchase of capital stock and their dividends for almost $1.8 billion. And we can see a smaller drop from the previous year in the total assets, um, primarily led by change in cash. Cash was used in. Okay. So this is actually a good thing that their assets are down, because what they did was in the best interest of the shareholders. They gave shareholder return by repurchase and dividends. Okay, so that means that would imply that their treasury stock would have gone up, right? So additional paid in capital. So their total common stock is down almost 20 million. Okay. So this also makes sense for retained earnings. That's fine. Consolidated operations. Okay. Oh, okay. So 3.24. So wait, I want to see how much did they change. So 2. Okay, that's fine. That was a wrong thing that I said about 20 million shares. So they have 3.24. Net income is this. Cool. So let's look at cash from operations. There we go. So net income. So net cash provided by operating activities would be our. So net income plus depreciation. I want to see. Okay. Why was this down? So net income was okay. This was higher in here. So depreciation was higher. Okay. Code related. Inventories. Primarily because they bought a bunch of inventory. So if we add that inventory back. 1164. So it doesn't make sense though. And this was down, accrued liabilities. So inventory, their assets, and their other liability. Okay, so their primarily issues were their accounts payable, their accrued liabilities, and their other assets. Okay, this is not as bad as it looks for their cash. Most of these I can see they're most likely one-time issues, for such as inventory, that once they sell those out, what percent of? All right, let's ask this. Let's ask, what percent of Coach's revenue is from China? What the heck? Percent of Coach's revenue is from China. What the heck? Okay, let's reload this. Okay. Well, that doesn't help. I want to see previous. Okay, so I want to look at Mergent. I want to look at Tapestry. Oh, god damn it. I gotta move this over here for a second. Okay, so we got TPR, Tapestry, and we're looking at company's financials. I want to look at the cash flow statement for the past 10 years, annual refresh. Okay. So for 2022, it says 856. Yep, that works. 2021. Okay, yeah, it's right here. What? This is so difficult to read. Net cash flows from operating activity. There it is. So there are these insane huge jumps, such as this one and this one. What are these primarily caused by? I want to see. So here they have insane. This is the highest amount of inventories they've had in the past 10 years. What else? Okay, their other assets were down last year, and then they made that much. Why is this absurdly high? What was their okay? So their net income that year was just very high. But what we're seeing a trend of high net income. I want to see what was happening during the recession. How that was affecting their net income. So they got any more all available years refresh. Okay, so let's look at 500 million, 6, 7, 6, 7, 8. Whoa, they were making all-time highs during the recession. Million. So they went down. Okay, what was happening in 2016, 2015? Actually, 2018 to 2015. So it was like a peak right here, and then they were starting to go down, and we see another bloating. So their net income was negative during COVID. Okay. Well, I would like to study this trend a bit more. If I can copy paste this, that'll be amazing. Can I copy paste this somehow? I can. This is beautiful. Okay, I want to see the change in net income year over year. Close. So this is 22, 21, 20, 19, 18, 17. Oh, wait, no. 18, 9, 8, 17, 16, 15, 14, 13, 12, 11, 10, 9, 8, 7. Oh no, we only have to. Oh, 8. Okay, that's fine. That should be good enough for us. I want to see the difference over here. Equals. I want to see this for all the years. Percentage. Let's move this right here. Okay, let's do this. So let me get data, and let's copy this. Oh, no, equals over and -1. Okay, so equals over -1. That allows us to see the year-over-year growth. So they went down, down, flat. Okay, so they were growing right here. So they were growing right here, and then they went down, down. So there are these, so there's cyclicality that I'm seeing here. I just don't know what's causing the cyclicality. From what I was able to tell, the recession was actually a good thing for this company, because if you see, they grew during this period a good amount. During the peak of the recession, they were growing at their full pace, and then it hit. They stay relatively somewhat flat. But what they are doing good is this acquisition driven growth. Okay, COVID is just a fluke. We're not going to look at COVID. We're going to look at jump from here to here. Actually, 2021 was a fluke year. This was a fluke year. So we're going to look at the averages of this 2 years. Equals average. This equals this. So we're going to look at oh no, wait, equals shooks over equals, that doesn't even matter at this point. And we're going to look at equals over that. So I mean, they were relatively flat since. Okay. Give me 1 second. So let's do a discounted cash flow model now. Got a good idea. Okay, so I want to see their free cash flow. So free cash flow is free cash flow formula. So free cash flow is the cash left over after coming. Okay. Is sales revenue minus operating expenses plus taxes. So that's their operating income minus capex. So it's operating income minus capex, minus change in capex. So you're going to look at 2018. So we're going to look at estimate, so actual, current, estimate. It's going to be 23, 22, 21, 24, 25, 26, 27, 28. I want to see this year's, what they're projecting for the next couple of years. Let's see that. Oh, shoot, this is not what's meant to be seen. Okay, that's fine. Presentations and financial. I want to see this. Tapestry 2023 infographic. See this stuff, what they got here. Okay. No, don't care. Iconic. Okay. So that's Stuart Weitzman, that's Coach, and that's Kate Spade. Okay. So Tapestry fiscal year 22 is looking at 6.7%, 6.7 billion. In margins, I think. I don't know. Let's see. Asia is about 12%. Greater China is 15%. Oh my gosh. So that's what I was looking to get. So Greater China is 15% of their total revenue. And once Greater China starts actually opening up, I would assume that we would see greater revenue growth in the upcoming year. I want to see their current revenue growth and their projections. Great. Oh, that's amazing. 0.5% gain. We can expect this. Their gross margin is going down. Their operating income is 20%, and their earnings went up. Their SG&A is up a lot. Oh, that's amazing. 700 million of common stock. That's amazing. 700 million is how much? 700 million if each share is about, if we consider share price is 44 and they're buying 1 billion buyback. 1 billion, that's 10,000 million. Okay, hold up. 100,000, 10,000 million. 100,000, 10,000, 100,000, million, 10 million, 100 million, billion. Amount of shares bought back equals over. That's what the heck? That's units, tens, hundreds, thousand, 10,000, 100,000 million. So that's 277 million shares. Wait, do they even have that many outstanding? So hundreds, thousand, thousand, 10,000, 100,000, million, 10 million, billion. Wait, no, what? 100 million instance. Oh my gosh, I'm so dumb. Hundreds. 1,000, 10,000. So they have 241 million shares outstanding, and that's how many? How many is this? Oh, is this even the right amount? Hold up. Tens, hundreds, thousand, 10,000, 100,000, million, 10 million, 100 million, billion. And that is units, tens, hundreds, thousand, 10,000, 100,000, million, 10. That's 10 million. So if we take equals outstanding, what percent are they going to buy back? That's what I'm trying to look at. Equals, dang it. Change in shares, change. That's going to be percent change equals over. So they're going to, so just by buying back stock, they're going to, oh wait, hold up. I want to see, okay, over this. That's about 10.4%. So if you were not to, if the company was not to grow at all, you can expect a 10% growth year over year just by letting them buy back stock. That's great. I love that. Plus, they're giving out a dividend of 1.2 per share. So total dividend is about $300 million. Oh no, their buyback is $700 million. Damn it. So 7% growth there and 300. Okay. So 2 to 3%. 4.9 billion, 945, 50, 10,800. That's fine. I want to look at total. I want total data. So I want to see what percent. Okay, so cash from operations. I want to see what percent of cash. I want to look at free cash. Okay, so I want to look at depreciation. How much did they declare depreciation was? 195.3. So 218.7. 195.3. I want to look at. Hold up. Comes down net income. The net income for 2021 was 834.2, 856.3. Change in capex comes right here. So we're looking at 380 and okay. So change in capex for 2021 was 23.9 minus 116 equals 239, 23.9 minus 116. And for 2022 it comes out to 93.9. Free cash flow equals sum of these three. Oh, sorry, same goes for this. Bolded. So they grew their free cash flow year over year. So their revenue. Wait, I want to see free cash flow as a percent of free cash flow as a percent of revenue. Free cash flow percent of GM. So when I equate this to over total revenue, total net sales, what was that? And their GM over gross margins. Where's that at? Wait, did I not get their GM? Oh my god, I'm so dumb. Oh, let's move everything down for a second. There it is. So their gross profit gross profit, sorry, gross profit. Gross profit is coming out to 3,312,4. No, that's not right. This is 3,239. 4081.9 4650.4 4650.4. Okay. Equals over total net sales. I'm gonna take this as percentage. Copy this, paste that, cool. So free cash flow, okay, I'm gonna copy this, paste that, and make this percentage C percent. And I'm gonna equals over gross margin, gross profit. And not bold, I'm gonna make this percent. This, okay. Thank you, appreciate it, Sammy. Thanks, let me actually text him back, thanks. So free cash flow, okay, revenue growth, gross profit, GP percent, GM, free cash flow percent of GM, gross profit, free cash flow percent of rev. Okay, so, and then we have our discount factor, and we have our, what just happened? Discount factor, no, free cash flow, this comes down for a second. Rev, and then discount factor. Discounted free cash flow. So we're looking at revenue, free cash flow, and then discounted free cash flow. We're also going to look at gross profit. So for 2021, we had total revenue of equals 6685. I'm going to look at current in a second. Equals above over that equals over that. So this is all both percentage. This is okay. Their gross profit was equals that, and their equals that, and then their this was just gonna equal that, and this is gonna equal that. Cool. And their free cash flow was equal to that, and their free cash flow for 2022 was equal to that. Free cash flow as a percent of revenue was above equal revenue, this, and this was equal this over gross profit, and this is going to equal that. Wait, hold up. Oh wait, no. Copy and then paste. So this is all percentage. This is going to be bolded. So our discount factor calculator, I'm going to hold up. Where's my other Excel sheet for HPQ? Has the best one, I think. So I'm just gonna copy this. Okay, I'm just gonna copy this into the other one. This makes it easier for me in my life, you know. I'm gonna remove all this though. I don't really care much about this. Okay, so free cash flow year 5. We are still deciding on. Wait, hold up. So we get that, we get that. Okay. So what they were saying, they were expecting a 3% growth this year. So I'm gonna give them a 1% to be conservative. I want to see what else they said for their PowerPoint. Okay. They are saying ahead of fiscal year 22. So we can expect gross margin to be around, give them 69.9, 69.8%. Times 1 plus this. 2 equals this times this. Free cash flow as a percent of revenue has been around, so I'm going to give them 13% to be safe. So that's a reduction. That's fine though. How are they? They're not generating $1 billion in free cash flow. How are they expecting to pay off their share buyback plan and their? Interesting. Okay. It's 4:10. Well, I have to head out, so I'm gonna continue this in the next stream. Thanks for dropping by.